I'm gonna show you how I would start day trading over as a complete beginner if I had to start over from scratch. I wasted over 5 years trying to learn how to trade and thousands of dollars wasted losing trades over and over till now. I'm consistently making money and I'm making over $1,000 in one single trade, only taking 90 minutes a day. So I'm gonna start by giving you the knowledge you need to understand markets, why they move, and how you can profit from those moves. I'm gonna give you the tools and websites you need to get started trading, plus a plan for you moving forwards on how you can accelerate your trading learning curve as fast as possible. Now, first off, let's look at a simple stock chart. The whole reason why price goes up and down is all because of supply and demand. As the price of any chart you're looking at goes up, that means there is a higher demand for that current asset. And then if it slows down or starts to go down, that means there is less demand and an increase in supply. And so this is what makes markets go up and down, is essentially there's more demand, then there's supply, and so people are willing to pay a higher price for it. Versus when people don't want it as much, well, they're willing to buy it for cheaper and cheaper and sell it for cheaper and cheaper, which also pushes the price down. To give you a more robust example, if we take a market, let's say a stock of Apple, and it's trading at a range between $100 and $110. Well, you as a trader of Apple, when Apple is down at $100, you really like that price because you think, well, from $100, you think it's gonna go up a ton from there. And so what do? You buy a bunch of Apple stock and shares and you sit and wait. And as more people think that because it's at a low price, well, it goes up in value. And so what continues it higher is even at 105, people still think, hey, I think it's gonna go up higher. And so I still want to buy it at this price, and thus pushing the price up even more. And so let's say when it comes up to 110 a share, you think that, well, it's a little overpriced and I'd rather sell it and now get $110 for what I bought before. And maybe there's a bunch of other investors and traders thinking this. And so that's how it starts to shift where, maybe it doesn't go up in its uptrend anymore. It starts to go sideways because the demand and supply is starting to become in more of an equilibrium. That's what makes a market or a chart of an asset start to go sideways, is there's an equilibrium in the supply and demand. Now let's say the Apple earnings come out and it's really bad, and that would reduce the demand for Apple and it would make the stock plummet because people would say, hey, it's overvalued. I don't want to buy it at that price. And so people are now trying to get rid of it, but they have to keep undercutting each other because nobody wants to buy it at that price. That's how a chart can drop so quickly, is because there's such a gap between where someone wants to sell it and someone will be willing to buy it. All of this back and forth and supply and demand creates buying opportunities for us as traders. We're able to see where are these supply and demand zones and trade based on that. When it comes down to, let's say, a demand zone, we say, hey, it is undervalued and I'm gonna buy it, and you're able to profit on that move up. That is the whole way that as trading, you take advantage of moves up and moves down in the market. Whereas investing, you're generally just holding it and hoping it goes up over time and the long term. If we look at the whole goal of trading versus investing, they have a lot of differences. If you look at, let's say, investing $1,000, over time, if you're putting it in the S&P 500, you're gonna get an average of 10%, 11% historically. The last 20 years have been pretty good and you've been able to get a little bit higher, but generally what you're gonna do if you invested $1,000, every year you're gonna get 10% return. So after a year of investing $1,000, you get $100. Now when it comes to trading, things are a lot different. If you take trading $1,000, well, generally you don't put up your whole account on one single trade. What you do is you invest a portion of it, let's say 5 or 10%, and you place that on one trade. And for one single trade, for a quick example, you can take $100 on a smaller time frame chart, one of these more smaller swings like Apple has had, and you can make, let's say $200 because you're risking 1 to 2. Now we'll get into the math a little bit more later, but essentially you're able to take advantage of those volatile moves and get in with a very accurate spot towards, let's say, the lows of a swing, and then get out at a very accurate spot at, a previous supply level that you notice. This allows you to drastically improve how much you can potentially make. Now, when it comes to investing, it's a lot more safer, especially with larger amounts of money, because theoretically, to lose your $1,000, the whole stock market has to crash, and that is extremely unlikely. And if it does, you probably have larger problems than losing your $1,000 or however much money you have in the stock market. But when it comes to trading, on every single trade, you can risk something like 5 or 10% of your account, and you can do this multiple times per day. You can also lose 5 or 10% of your account in a single day. To show you a quick example is the ability that you have as a trader to jump in here at the lows with a super accurate entry, and then with a larger trade, you can capture a massive swing up where you can make a few $1,000s in this trade was 20 or 30 minutes before it ended up closing out for pretty much $3,000, and I was risking about $600 on that trade. So when it comes to trading tools, what I highly recommend you do is, for getting chart access, learning, practicing this, get NinjaTrader. I've been using it for over 5 years now, and I'll leave a link in the description below, or you can scan this QR code. I recommend getting set up right now so you can go along, look at the charts that we're about to look at, and start demo trading and practicing a strategy that you're going to be learning. Now, the next thing for setting up is what asset or market you're going to look to trade. There are so many options out there, and with my experience of really going through all of them, futures trading is the best thing to do for starting a small account and scaling it. It allows you to have simple entry and exit styles. If you look to trade options or other more complex markets, those are a lot more tricky when it comes to just saying, hey, I like this spot, I want to buy. And so futures are really simple for that. You are trading the major markets in terms of like the S&P 500 futures, assets like oil or gold. And I've always found those to be a lot more reliable and consistent for trading, which is really important when it comes to being consistently profitable over the long run. Having crazy volatile penny stocks or cryptocurrencies makes it a little bit harder, in my opinion, to consistently get a feel for how the market moves and make money over time. And then the last thing is, when I've tried to trade Forex, there's a lot of funky fees involved, especially with trading a small account. And then when it comes to trying to trade stocks and just buying shares of, let's say, Apple and waiting for it to go up and then selling it when it's kind of between those levels, you have run into something called the pattern day trading rule. What this essentially means is you have to have $25,000 in your account to be able to place day trades consistently. And futures really allow you to start with something as little as $100 or $500 in your account. You can start practicing demo trading, and then you can switch over, which we'll talk about in a minute, and you're planning on growing that account. Now, once you have NinjaTrader set up, you're gonna be able to access the charts. I'm just on their web-based platform right here. It's super easy to access pretty much anywhere. Initially, I recommend opening up a chart here and then just looking at the ES futures. This is just the S&P 500. It's the main US stock market, and it doesn't really matter what you trade at the end of the day. What I just went over, that's my preference, and I suggest you doing it too. But when it comes to analyzing charts, you can trade any market you want. The analysis is all the same because it's based on those supply and demand moves that we were talking about. The markets always consistently bounce between supply and demand levels, no matter what you're trading, and so you can easily place trades based on those. Now, when it comes to reading candlesticks, it's pretty basic. The whole idea of why you have them over just a basic line chart is to give you more information. Essentially, a red one is telling you that the price essentially went up over that candlestick, and a red one is telling you that the price went down over that candlestick. So for a green candlestick, you have the body or the main colored green box, And that essentially tells you that the price opened here and closed here. And then the line above it, or the wicks, is where the price moved between the open and the close. And so essentially what that could look like, what the price could have happened, is it could have opened up here, sold off, punched higher to the high of that candlestick, and then come at the close. And that would have created that candlestick. Same thing for a red candlestick, but on the flip side is the price actually opened here, probably moved up to this high, sold off, and then eventually came and closed at the closing price. And so that's how all these candlesticks work, is you can look at them and they'll all give you an idea of what is going on, a kind of underneath the hood and a little more data. You know, this one says, hey, the market opened up right here, went all the way up here, and then closed right here. So that is a really bullish candlestick. Bullish just means that the price moved up, and bearish means that the price moved down over that candlestick. And so it might seem like a lot of information that you can't really tell what these patterns mean initially, but what you'll eventually realize over time is they just help you understand more of what's going on. And so the biggest thing initially is you don't need to be paying attention to these smaller patterns that are created. What I have found over time is it's actually better to pay attention to the bigger picture. And that's what you can start to make with these candlesticks, is you can start to say and look at, okay, where are the big swings in the market and where is it showing that it's kind of choppy? And basically how you can see that is with how these candlesticks look. Is right here, these candlesticks are showing you there's a lot of bearish movement to the downside in one direction, a lot of volatility, and then a lot of the times, well, you can see on the flip side, it had to reverse that volatility because there was supply and demand imbalance. And so there all of a sudden was a ton of supply, people wanting to sell, and then all of a sudden there was a ton of people saying, hey, I actually like this level where this price is at and I want to buy it. Versus compared to these candlesticks here, they're really choppy, essentially just saying that they're all just kind of off back and forth. Essentially over all these candlesticks is the price went nowhere. You know, again, showing that supply and demand equilibrium. And this is not a spot where you want to be placing trades. And so that's why it's really important to be zooming out and looking at the big picture of seeing, okay, where is the supply? Where is the demand? Where are essentially the extremes in the market that actually look like good selling or buying opportunities to place a trade? That is the whole tricky part of trading, is being able to understand and look at a chart, wait for those areas where it's maybe in a supply level or in a demand level and place a trade on that, and then avoiding these areas in the middle of those supply and demand levels where it's a lot harder to know what something's gonna do. Patience is probably one of the number one factors when it comes to trading and allowing yourself to have consistent profitability over the long run. And so I'll leave a link to a video that explains way more on technical analysis and understanding charts than we do here. But the next biggest thing that when it comes to trading is you have to learn how to accept losses. They are just a part of the game and a part of the process. And probably one of the most important things about trading is the mental side of trading and being able to understand that losses are a part of the game. And you have to be more focused on the math of it and the whole goal of consistently over time making more money than you're losing. So to illustrate this a little more with some math, let's say you're trading and you lose $100 every trade. But every time you win, you're trying to go for, let's say, 3 times your risk. So you're looking for $300 a win on average. So let's say over 10 trades you have here, that you have 7 losses over here and you have 3 winners. But the winners, because you're kind of going with these swings, you are winning more than you're losing. Well, what this comes out to is, total, you're losing $600 over those 10 trades, but your average loss is $100, and then you made $850 over those 3 wins because they were larger wins and your average win was close to 3 times your risk. Well, if you take your total profit loss between those 10 trades, well, you were actually positive $250 overall. And the highlight here is that you had a 70% loss rate. Even though you're losing a majority of these trades, because of the math and how you've set things up, you are still consistently profitable over those 10 trades. That's the whole reason why you can't get married to one trade. You can't actually, one of the biggest mistakes people do is they will make their losses larger. They'll say, I'm gonna risk $100 on this trade. They put their stop loss at a certain spot, and then they actually move that stop loss farther away, increasing their risk to, let's say, 150. And what that does is it messes up the math and it makes it so they aren't consistently profitable over the long run. And what you have to realize is you don't know the outcome of any trade. No matter how good one trade looks, it could totally become a loss. Now, if I pull up the actual NinjaTrader platform, if you get NinjaTrader, I highly recommend using that instead of the web-based version, just because it's a lot more powerful. Now, to go into some basics of technical analysis and chart reading that is super important for your trading. First off, you want to think about time frames. If I quickly look at, let's say, a 30-minute chart, you can see that over a couple days, there are a few candlesticks made. You know, if you have a daily chart, that means there is one candlestick per day. And this is saying it's a 30-minute chart, so there are a lot more candlesticks with one made every 30 minutes. And so what this allows you to do is it allows you to either see a bigger picture if you want to kind of zoom out and see what the market's doing, or if you want to zoom in to what's happening right now. And even though you can see on a 30-minute chart, this just looks like chop back and forth. But if I go into a 1-minute chart now and kind of zoom out to essentially showing that small section, you can see there's a lot more back and forth and potential trade opportunities. And so this is why it's important to realize that you can trade on a smaller time frame if you want something a little more fast paced, or you can trade on a larger time frame if you want something slower that plays out more over time in multiple days or weeks. But the biggest thing when it comes to looking at these charts is looking at essentially the big picture and the structure. Knowing and understanding the structure of what is going on really will help you paint a picture and understand what's going on. And so generally, you have your basics of an uptrend is made by higher highs and higher lows. And then a sideways trend is essentially where the highs and the lows are roughly the same. They don't have to be perfectly, at the exact level. And then a downtrend is signified where the market is starting to make lower lows and lower highs, where consistently over time, it's moving lower. Now, this can depend on what time frame you're looking at as well. And so just because you are looking at a, let's say, 30-minute chart where the market is clearly in an uptrend, well, that doesn't mean you can't go into a 1-minute chart and say, hey, I think, because the market's come up here and made kind of a triple top, that I don't think I can make money and bet that the market's gonna go down and have a small downtrend on the 1-minute chart. And so don't get, a bias based on a larger time frame if you're really looking to trade at a smaller time frame, because the larger time frame trend doesn't necessarily matter. Now, a couple of other important things is drawing supply and demand levels. I like to look at a bigger picture than what I'm trading. And so if I'm trading on this 1-minute chart right here, I'm looking to enter in trades. What I want to do is I like to look at a 15-minute chart or a 30-minute chart to see, okay, where are the major swings and where essentially the supply and demand zones might be. What I like to do is essentially stick to the extremes. You can see this is still in a pretty tight range here, but over the last kind of 24 hours over this section is the market's been essentially ping-ponging between these highs and lows. And so what I want to do is then if I go into a 1-minute chart, and I'll actually draw these on the chart so they will transfer to the 1-minute chart when I zoom in, is anytime the market comes up to this either supply zone or resistance zone or down to this support level or demand zone, I want to look to buy down here and sell up here. And so what you can do now, knowing where those zones are, is you can just, again, look at the basics of reading the candlesticks, of saying, okay, the market's in an uptrend here. It's making higher highs and higher lows. And so it's in an uptrend, and I'm not gonna look to essentially bet that it's gonna go lower. You can make money either direction. I actually generally make more money betting that the market's gonna go down, but the whole idea is okay, as this starts to go sideways here and go into more of a sideways trend, without trying to really look at the candlesticks, you can see that it's gone in a clear uptrend to now going sideways. And so based on that, well, you can say, okay, it's losing steam here at this resistance zone. And so it's likely, based on just those two factors, that it could start to shift lower. And so that's how you start to understand and read the potentials of what the market can do. Now, that doesn't necessarily mean it's going to sell off, right? Again, it's all part of the math of it and saying, okay, I'm going to use, let's say, these two signals to say, I think that market's going to go down and I'm going to bet that it's going to go down. And that doesn't necessarily mean it is going to. It could sit here for a while with that kind of equilibrium, and then all of a sudden demand could pick back up and it could keep going higher. And so that's why you have to keep that math in play, so that when you're wrong, it's not a big deal. But when you're right, you're able to capture a nice swing down and profit to offset your losses and make a little extra. Now, let me lay out a roadmap for you to start on this journey to getting to a real money trading account. The whole idea is, on this roadmap, you're starting out learning, studying, and what you want to do next is you want to then develop a strategy. My advice is keep it simple. You can see I just went over a simple idea of how you can kind of see where the market's going based on super simple factors. The funny thing about trading and the markets is it seems like it can be really complicated, and it can, but it can also be really, really simple. The complicated part about it is actually consistently executing your strategy day in and day out. And so that's why I highly suggest demo trading using something like NinjaTrader, because it's going to allow you to kind of get started, understand charts, understand really how trading works without losing money, because in trading, mistakes lose you money. And then when you've been consistent for multiple months, because the market has cycles, times where it's super volatile and times where it's really good for trading, and then times where it's really flat, choppy, nothing going on, and it's really easy to blow your account because you're used to a super volatile environment. And it only takes time to really know that you can handle those, and then switch to a real money account. Now, this is just a super quick trading roadmap. I have actually created a whole multi-page PDF that you can get for free that lays out you a 90-day roadmap of something that you can do and focus on every day over the next 90 days while you're going in to this trading journey. It's gonna have a ton more resources, tips, and helpful suggestions that will keep your trading on the right track and keep you away from wasting 5 years like I did. Now, if you want a strategy that has worked for a ton of other people who have tried it out, check this video out right here. It'll give you a step-by-step process. And if you want to get NinjaTrader, you can check it out right here, and make sure to get that 90-day roadmap as well in the description below.